Well, hello everybody. Today is October 21st, Friday. It's about 4:45 p.m. as I'm recording this. The market's closed about 45 minutes ago. Um, haven't done a video update in a couple weeks, so just thought I would revisit a couple of the charts that we've been watching. For those paying attention, the last, it looks like maybe 10 days or so have, with the exception of just a couple, maybe 2 or 3 days, been very positive in the stock market. Admittedly, been a bit of a pessimist here lately, and so I'm hoping that what's transpired over the last handful of days can continue. But we still want to watch a couple key levels, though. I should say that it does look like perhaps the lows for the year have been set. That's what it appears to be to me. So I don't know if that necessarily means that we'll go zooming significantly higher between now and the end of the year, because there is some important resistance. But it does look like perhaps the lows have been set. So that's a good thing. What we're looking at right now, this is a daily chart. So I've shown this before. And I drawn in the past this wedge pattern. And that kind of represented the channel that the stock market was trading in. And, it looks like at the end of September, we'd broken through the bottom of that and stayed below it really just for 2 days. And then popped back into that range. And we hit a little bit of resistance on the top end of that particular wedge. And when it broke through, I said, boy, we better watch and wait just a couple of days, see if it can stay there, because last time it broke through the bottom, it ended up jumping up to the top. And really, we just went through a series of 5 or 6 7 to 10% rallies, followed by 7 to 10% declines. But fortunately, it has been able to stay there. We can see that a couple times it struggled. So each one of these bars represents a day. And we see the first time it broke through, it then actually the next day went down and kind of looked like it was going to fall below the wedge, and then it rallied back up, and so that looked very strong. But then the following day, it dropped right back down to that particular wedge. Day after that, it actually fell down and looked like it was going to go back down into a downward trend. But then towards the end of the day, it rallied and finished up. That was followed by, of course, another down day. But now we've had 2 days in a row that we're back to back up. And yesterday, actually, again, looked like it might be, the day that the market would fall back down to that wedge. This sort of long, thin line there is the intraday move. So the market actually fell below 1200 and looked like it may go back into that range again. But then today, the significant rally to close the week is sort of suggesting that this is an uptrend that may be sustainable. So that's all very positive. A couple other things that we've been looking at. This line at the bottom, this was what was called that rate of change measurement. So it was always measuring the past 4 days. As I said before, every time it would go up for 4 days, and for a few days it'd go down. Then it'd go up for a few days, and so forth. And it looked like, again, it was going to come back down, but now it's reversing course a bit and heading back up. So we'll see if it can sustain this. Though, as I said, measured on a very short-term basis, like day by day, the market does appear to have broken out of that range. And if it continues to go up, sort of the next resistance point would be about 1,270 or 1,280 in that range on the S&P 500. So to me, that would suggest that we should see, though I don't think it'll be a straight line, there'll be some up days and down days, but I do think we'll likely get to 1,280, which would be a move of about 4% or so to the upside before we run into any more downward pressure, at least, on a sort of sustained basis. That's again, just what it looks like at this point. Looking at a couple of our other charts, I wrote a long post last week about this one. This was the one that, was a series of indicators that I had created just to measure the long-term momentum of the market. And in the post, I talked about how, it's had a couple false signals or false warnings. And at this point, that cannot be confirmed, though it does look like that may be the case. And, the last 2 times it gave false warnings would have been the fall of 2006, as well as the fall of 1998. And in the end, using measurements like this are still proven to be effective. Like in the post I wrote about, I measured 15 years. And using this particular series of rules would have helped an investor get roughly double the return of the market with roughly half, or actually a little bit less than half, of the risk. So it certainly, I think, is valid over the long haul, though I also dissected a lot of the shorter term, like 1 and 2 and 3 year periods, and showed that there are times when having a risk management process actually backfires on you. And it can be very frustrating because what it can do, like in the Post I actually wrote about, how in the year 1998, had somebody been using this, they actually would have lost money that year, had like a 1.5% loss, and the market actually went up 26%. So I don't think too many investors would have been really excited about their supposed risk management strategy that caused them to get beat by the market by 28% in 1 year. However, the next warning after that was a precursor to a 50% decline in the market. And so investors who were following a systematic approach like this would have been rewarded significantly and more than made up for that one bad year. As easy as that is to say audibly like this, it would have been very hard for investors to stay committed because if they would have started, let's say, in like 96, from 1996 until 2000, they would have went 5 years. So they've been a 5-year investor, which is, somebody who's staying fairly committed, and their net result would have been 30% less return than the market, and they would have had a negative year while the market had none. However, if someone stayed invested from 96 until 2006, of course, that's a 10-year investor, they would have been rewarded significantly, would have had much better total returns, much less risk. The same thing seems to be happening now. If an investor had started using an approach like this, let's say in January of 2009, they'd have only gotten about half of the market's upside in 2009 and 2010, and then this year they'd be down 10%, even though the market's getting close to break even for the year. I don't think it's quite there yet, but I do know that it's pretty close. I think we only need to go up a couple more percent, and the market will be break even for 2011. So, investors following a system like this, using that time frame I just laid out, they'd be about 3 years in, and they'd have almost no returns at all. Their total return would have been, in the neighborhood of 18% for the last 3 years. So they've been averaging less than 5% a year, when an investor who is just buying and holding in the market would have, I think, had a return, would it be roughly 35%. So basically double the return, and they wouldn't have much of negative calendar years to speak of. So, that was what I wrote about in the Post, and this video just kind of confirms that. Again, here was the warning, this red bar, the farthest one to the right, and so far October is proving to be a fantastic month, though there is another 10 days or thereabouts left. So we'll see if it finishes that way. And this is a slow indicator, meaning that it's never going to go out in 1 month and then in the next month. It's usually going to, at minimum, take 2 or 3 months to confirm a change of the long-term trend. So, this could be, a signal maybe like it was in 1998, where the market dropped really fast, caused a warning sign, market recovered very quickly. So we'll have to wait and see. Again, I'm not sure if that's exactly what will happen. In other words, I'm not sure that a new green bar will resume because the long-term trend is still pretty broken. But there is a possibility of it. Moral of the story is that using any systematic approach that's proven to work long-term does not mean that it will always work in the short term. And short term sometimes can be measured in terms of 2, 3, 4, or 5 years. Now you have to keep in mind that an investment like process like this is really only effective if given at least 5 years or more to work. And anybody who does follow it, or historically would have followed it for 5 years or more, would have been rewarded significantly. Though there would have been some years they'd have been very frustrated, and that's to be understood for sure. So I've shown the very short-term view. That was the daily view. This is a little bit longer-term view, looking monthly. And I just thought I'd show somebody like an intermediate-term view because I don't know if I've covered this much in past posts. So let's see if this one loads. So here's it's more intermediate-term view, and I do have to change the settings. So my apologies for that. Let me change that for the last 3 years so we can get a little better view. So there's more or less an intermediate term view, and I drew some lines on here. I won't really discuss those much today, but it's essentially using a lot of the same triggers for sort of entry and exit points, like I did in the monthly one. But I drew in a secondary red bar. You'll see the one that's dashed, and what that would mean is kind of like if this red bar was the warning, the dash bar would be sort of like the warning's over. In other words, it's looking like things could turn positive. It's not quite there yet. So in other words, if we were to look at this at the last 3 years, every time there's a dash bar, an investor might want to be very cautious. But it does show that perhaps the decline is getting ready to end, and it just serves as a bit of a precursor for perhaps a new bull market. And when we look at the last few years, you can see that this would have given some nice warnings. This doesn't quite show 2008, but it would have warned, for example, the entire 2008 bear market, and then given people a heads up of maybe 4 to 6 weeks of when a new bull market would start. And using those indicators anyway, today would mark the day that perhaps the worst is over, and in the next 2 to 6 weeks, a new bull market would start. So that's all very, again, positive, I think, in the intermediate term. If we put those three things together, the short term, the longer term, and the intermediate term, what it would spell out, just to make sure this entire video makes some very crystal clear sense, is that the long-term trend is still down, despite the fact that the short-term trend has now turned positive. And the intermediate term trend is neutral, meaning this dashed line is kind of like neutral. It's not really in a bear market. It's not really in a bull market, just neutral. So what should an investor do in a market like this? Well, interestingly, one would definitely not want to bet against the market going down at this point. So having like short positions or anything like that would not be wise. But it also would indicate that being 100% bullish is also not wise, but having some exposure to the stock market would be. So if we were looking at, for example, a balanced investor who keeps typically, let's say, 60% in stocks and 40% in bonds, what they might want to have right now is maybe 25 to 30% in stocks, and then their typical 40% in bonds, and then the balance in cash or short-term securities. It'd be a very conservative approach. You'd still get a little bit of the upside if it keeps going up, but be insulated if it goes down, and of course ready to move into a more defensive position if these trends change. So that's it for today. Just wanted to, again, make a video update, show everybody what's happening. Again, positive developments in the short term in the market, as well as less bearish news in the intermediate term, but still a lot of caution on the long term. I'll probably post again next week because some of these things may change a bit, but hope everybody has a wonderful weekend, and I will be back in touch relatively soon. Thanks a lot, and have a great day.